Welcome back to Capital Connection. Thanks for staying with us on the show. Well, David Costa is with us now. He's Dean at Robert Kennedy College and joins us live from Zurich. Thanks for coming to visit us this morning and sharing your thoughts. So you're talking about all of the black swans, as people might call it, that we've had in the past month, all of these exceptional events and the impact that's had on the markets. I know, reading some of your writing, you believe that there's no confidence left in equities. I guess that makes sense. But why do we keep seeing markets closing higher like we did yesterday?
Good morning. Well, I think the loss of confidence has been so much that markets are at the moment largely oversold. And when markets are so oversold, there must be some of the buyers who step in and buy. And I think that this actually represents a good opportunity, because what we had on the market is 4 events that are unexpected, or 4 black swans. One after the other. We had Europe, we had the American debate about debt ceiling, we had a downgrade of US debt, which is really highly unlikely, and we also had this persistent throughout the month. High volatility on the forex market, so it looks like investors don't know how to make up their mind on which currency they want to hold. And the fear currency, the Swiss francs, have recorded new highs both on the euro and the dollars almost on a daily basis. So I think that depending also on the currency you're starting from, but some of the markets still present some value now. That's why we saw yesterday this bit of a run up, because markets are largely oversold at the moment.
David, it's really interesting, given that people obviously seem to think that gold still has some value. It's quite a game changer since that downgrade that we saw from the United States, because at some point there was a lot of talk that hedge funds were liquidating their purchases of gold, but certainly it seems to have changed. What's the game changer there?
Well, in my previous interview, I've said that gold will reach 1,800 by the end of the year, and it looks that it's moving much faster than I expected. I think what could have happened now is that after the downgrade, we have some new players stepping in and buying, which could be central banks. And if that is the case, we really see a transformation of gold from a commodity speculation into more of a real currency, or a way to diversify, because as we know, there isn't much of an alternative to US bonds. Really a fly to say, I want another currency, I want something else, and gold might be the reason. That said, I think that gold at this point is largely overbought, so I would have preferred a slow path to the 1,800 by the end of the year. When I see these big moves on the upside, I also expect potential correction on the downside in the short term.
Right, David, I was just looking at the 3-month gold chart. It's fascinating to see that climb towards that last month in particular. Again, you're worried a little bit about a correction. What about other precious metals like platinum? One analyst pointed out to me that it was now 1-to-1 with gold, and that could be a good opportunity to buy it.
Well, on the last sell-off, we have seen all commodities, all precious metals, with the exclusion of gold, pretty much stepping down and having a correction. So I think one way to play it is, again, broad commodities might have some run-up. Platinum, again, is very much dependent on what happens on the industrial side of the world. So if you have a negative market, platinum will not protect you as much as gold does at the moment. So I think, again, it depends also much on the currency turbulence, because, again, in Swiss francs term, the gold is not much higher than a year ago. It's pretty much at the same level, if not lower. So there is an impact of what happened in the US dollar, and that's why buyers are stepping in and buying gold as a way to edge toward a lower dollar, especially what the Fed said yesterday.
David, so I know your thoughts on gold. What else should investors be doing to protect themselves, do you think, in these volatile markets?
Well, I still think gold is just an edge which I would have in my portfolio. Some percentage point of my portfolio will be in gold. I think it is time to be a bit conservative, but I see value given the sell-off. We have multinational corporations both in the United States and Europe with strong balance sheet, a lot of cash. So I will go and try to find companies, for example, in the IT sector, which will do well even if we will have problematic like slow growth in the US and Europe, because they are exposed to a number of markets, including emerging markets. And those of names now are selling at a large discount. So I think it's a good opportunity here.
And David, we know that the Fed's going to keep interest rates long, at least for the next 2 years. But ultimately, the big speculation out in the markets is, what if they extend the maturity of their bond portfolio? If we get that announcement later in Jackson Hole, how is that going to impact your investment strategy?
Well, of course, that will have a big impact. Again, this is really unusual for a central bank to commit not to raise interest rates for such a long period of time. So we are, throughout the markets, in uncharted territory. And that's why investors are reacting with fear on the market, with uncertainty. And so, to some degree, if this comes out, there will be another disruption in the market, another difference, another thing that might make gold and other things going higher. So I really think at this stage it's good to be on a conservative stance, to try to buy those names that will do well in the future, have some gold, and really watch and see, because the situation is moving so quickly that it's very difficult to make any type of forecast for the longer term.
Right, David, a lot of the selling that we saw was as a result of the fear that there might be another recession, of a double dip. How much on your mind is that story?
I don't see it, as I didn't see it 2 years ago, where pretty much every economist was already playing the cards of double-dip recession. I see that in the US there is a lot of vigilance about that. There is a lot of action, much faster than in Europe, and that perhaps because in Europe a lot of investors are not on the market. I don't see a double-dip recession. Of course, the situation might change quickly, but I think the results of the sell-off was really these unexpected events, like a downgrade of the US debt, totally unexpected, totally unanticipated, and that is pretty much a very emotional market now, more than trading on fundamentals of this recession coming. So I see that as the main reason. Fear caused by unexpected events.
David, thanks very much for that. David Costa, Dean at Robert Kennedy College.